Hello again, everyone, and welcome to Quigley on Divorce, a behind-the-scenes look. Today is another great episode in sort of a series of episodes where we're dealing with finances in divorce. And there's a lot of interesting aspects to that, and it's something obviously everybody's concerned about in a divorce. I'm your host, James Quigley, and today I'm joined by two really special, smart, and really top-notch professionals today. First, and again, no relation, but great name, Christine Quigley from Schiff Hardin, one of the great Chicago law firms. Christine, welcome.
Thank you.
And John Swift. John, name of your company again? I don't want to butcher it, and I always do.
Benchmark Investment Advisors.
Awesome. Yep. And so Christine is a professional. She's obviously a lawyer and works in the world of estate planning. And obviously, there are a number of ways in which that comes into play in divorces. John also, as a financial and wealth advisor, very important in the world of divorce. And so blending those specialty areas into the world of divorce, I think we can really have an interesting conversation about what people, and I think for today, well, let's focus on coming out of a divorce. And sort of by way of almost developing a hypothetical, we've got an individual that comes out of divorce and has a $5 million estate, and there's some maintenance obligations, and one individual is obviously receiving it and one's paying it. At that point in time, the person says, I'm divorced. I got $5 million. One of the things I do is I say, okay, we need to talk to Christine and probably think about an estate plan, because that $5 million is now yours. What to do with it isn't my expertise in terms of planning and protecting it, nor is it my expertise in terms of how to invest it. So Christine, in that type of a hypothetical, what's one of the first things you look to either learn or, have a conversation with someone in that perspective?
So a lot of it really comes back to what was the nature of the divorce? How's the relationship between the spouses post-divorce? And are we assuming that there are minor children in our hypothetical?
And that's when we can certainly add, because many times there are. And that's another component, because there's a child support. And by the way, how are we going to plan for the educations and our grandkids' educations and so forth?
So the general rule under the law is once you're divorced, your will continues to exist if you have one in place, but provisions that benefit your former spouse are revoked. So if, for example, I had a will that said, I leave everything to my spouse, or if my spouse doesn't survive me, to my children, then once we're divorced, the usual rule is that my spouse is no longer my spouse, doesn't take if I pass away, and everything would go straight on to my children. But state laws differ in a number of fronts with respect to questions like, well, what if my will, as is very common in married persons' wills, said, I name my spouse as my executor? Would the spouse continue to act in that role? What if I have a trust that's created for my minor children and I pass away? Does my former spouse get to be the trustee of that trust and manage those assets? Or do I want someone else unrelated in that role? And then, of course, there's always the questions of guardianship, depending upon, if I pass away after a divorce, if my former spouse passes away, who's going to be the guardian of these children? And you name your guardians in a will in general. So I don't think I have ever in my professional career seen a situation in which people came out of a divorce and there wasn't some change to an estate plan that they really needed to make.
So when those people come to you, and by the way, that's, you give a perspective of someone that may have had a plan during the marriage.
Yeah.
And of course, there may be individuals that haven't had any planning, and so we're starting from scratch.
Well, and that's important too, because the law really is designed around this concept of institutional marriage, right? We have so many laws that say, by default, our inheritance law says, I'm going to give half to surviving spouse and then half to children. If there is no more surviving spouse, do you want everything to go to children? Or many married couples hold things in joint tenancy with rights of survivorship, in which case all of it goes to surviving spouse, and then a surviving spouse can continue to control those assets. Well, that's going to look a lot different if the people who you're holding in joint tenancy with are, your 5, 7, and 9-year-old children, as opposed to your 40-some-year-old spouse. So it's almost universal that people who are getting divorced, have been divorced, and don't have a plan, but have assets, have our 5 million in assets, need a plan in place.
Okay. And so it sounds like, and I'm not sure chicken or the egg, someone comes out of a divorce and they've got this money. We're just using a hypothetical $5 million. We've talked before, and I understand people come to you, and it's almost a reverse engineering that takes place. You have to figure out what's our longer term plan financially. Right. Or it sounds like Christine is saying we have to figure out longer term legally but at the end of the day, it's where do you want to be, and then we kind of figure out how to get there.
That's right. I mean, it's part of the divorce process to define what that's going to look like in terms of assets and income, retirement plans, and so forth, how those are going to be separated. Our job is to, if we're working with one of the spouses on either side during the divorce, to work through an equitable and hopefully non-contentious result there. But if we're brought in after the fact, and they have, say, this $5 million, is to understand, well, what does the future look like? What are their goals and objectives? What does the budget look like? That's the first and most important. Let's pay the bills on a current basis, as well as look for savings. What are we going to get down the road? What are our goals for vacationing, homes, our children's education, and retirement? And understand what that financial future looks like. So it starts with a financial plan.
Okay. When you say it starts with a financial plan, if you can, for the viewers and the listeners, try to blend, someone comes to you and they've got a financial plan. As part of that financial plan, are you saying, hey, by the way, I can invest your money this way, we can pay these bills, but you need to talk to Christine to kind of wrap a bow around that financial plan legally?
Standard of every new client that we get is to complete kind of a personal financial plan for them, but also that incorporates what is their assets, liabilities, income stream, income, and balance sheet. We also look at their IRA beneficiaries. I mean, can't remember a time where we don't go through that process and find that, especially people of a recent divorce, that the beneficiary is still their ex-spouse, or the life insurance policies are still basically the primary beneficiary and their ex-spouse. You really want to do that. So that's where we get involved with not only updating titling, which is a pretty simple process, but understand the trust and estate plan that's been put in place.
So kind of to dovetail on that, if we've had some real estate, it's titled a certain way. We've got, whether it's retirement benefits or even just investment assets, there's beneficiaries pre-established. So is part of what you then do in terms of creating this plan is almost undoing some of the stuff we did before and redoing it in a way that kind of makes sense now that I'm a divorced person, it's my money, and I can do with it what I want?
So something that I'll emphasize that applies to everyone, regardless of marital status. It is a fallacy to think that your will controls the disposition of all of your assets. To the extent that you have accounts that have a beneficiary designation on them, and you have a designated beneficiary, like that IRA, there are certain securities accounts where you can designate a beneficiary, life insurance. If you have a designated beneficiary, those assets are not controlled by your will.
Okay, time out, because again, coming from a divorce lawyer's perspective, I need to understand this, and I do. But so they understand this. When you say, "Boy, what do you mean? I've got a will. How does that not control, my pension benefits or these assets I have in this account?" Can you
absolutely
bring that down?
Yeah. So let's say we're married, and the lawyer and I've created a will that says I leave everything to my sister Sally.
But haven't changed your beneficiary
I haven't
designation
changed my
yet.
beneficiary designation yet.
And so
John,
even though the will says, I leave everything to my cousin Sally or whomever, the beneficiary designation on the plan is kind of
says John gets it.
right.
So long as we're still married, so long as there isn't a final judgment of divorce. And here's where things get a little bit murky sometimes. Because remember how we talked earlier about how you have a revocation of a will leads to basically canceling any gifts to the surviving spouse? Well, with all those beneficiary designation kind of things, like the life insurance, the IRAs, etc., the law's not uniform. The plan's not uniform as to whether my change in marital status itself will revoke that beneficiary designation.
So sometimes that's baked into the plan itself.
Sometimes it could be baked into the plan or the account itself, but the important part is that I need to change those beneficiary designations, right? And sometimes, the law might be different in one state than another for certain types of assets like life insurance, right? It doesn't apply to retirement assets because that's governed under federal law. But like life insurance, in one state, a divorce could revoke a beneficiary designation. In other states, it doesn't necessarily. So we're always looking to really make sure that the beneficiary designations are up to date post-divorce.
Okay. And the same would be true, I think you mentioned titles. So if, again, under this scenario, if they owned a home and a summer home, and they were both titled in joint tenancy, there's a process of unwinding that, and maybe there's equity buyouts. How do you deal with those issues?
Well, obviously the quadro, qualified domestic relations order, is going to define how those assets are being split up. We want to make sure that the titling is consistent with that order. And I see many times where there's an inconsistency between that. So we help them through, and it's a legal process of retitling. But we're there to understand, what needs to be done, what hasn't been done. And it's frequent that it's either a titling issue or this IRA designation, beneficiary designation needs to be updated, or other pension plan, life insurance designations need to be updated. Titling is important because it oftentimes gets just missed, or we knew it. That's why we've created checklists. Divorces, there's a number of things that need to happen. Like fly a plane, you have a checklist. To go through a divorce, there is a checklist of things that need to be taken care of. So we make sure that nothing falls through the gaps from a financial standpoint.
So let's assume, again, back to our hypothetical, folks are divorced. You guys have gone through your respective checklists in terms of, we're looking at, how things are titled. We're looking at beneficiary designations on the assets that have been awarded to this individual. And so now we're kind of at a place of saying, what's the right plan for that individual, and how do we fund it? How do we make sure, there's a synergy between what assets I have and how we're going to invest them, and what plan we're coming up for in the future. And so what is it, again, I said before, kind of a chicken and the egg. Do we start first with understanding the financial plan and then fit the legal plan around that, or does it even matter?
I think it could be contemporaneous.
Yeah, it really is. It's generally a joint effort. My starting point is usually give me some idea of how much money we're talking about, because it's a very different plan for someone who has, 500,000, 5 million, 50 million, 500 million, right? And tell me a little bit about where this person is in life. It's a very different plan for someone who's
where they're in life, meaning I've got someone who's 39 versus 59.
Exactly.
I've got someone with 3 children, no children.
Exactly.
I've got somebody who's on their 30th marriage.
Versus it was a first marriage. Yes.
Because I would assume you'd have to look at, and I think both of you, it's interesting, as a divorce lawyer, we are going to build into the marital settlement agreement certain obligations. You mentioned life insurance before. And, it may be a requirement of a client or an individual coming out of a divorce that they have to maintain $5 million of life insurance. So that might be something where on the financial side, you're, giving advice in terms of how, like, how cost it at term versus whole life. Also, are there term what are different? Are they different?
Exactly, and that makes a very big difference because one of the things that people often don't understand if they haven't been through the estate planning process in depth, proceeds of life insurance are not subject to federal income tax, but they are subject to federal estate tax, meaning they're part of the taxable estate. They're taxed at a 40% federal rate, plus many states like Illinois have a state tax on top of that. So we want to put those life insurance policies into a life insurance trust so that we aren't facing a tax of basically 50% when a person passes away. And again, that's only on assets over a certain threshold. That's only for the very wealthy. But when it hits you, it's not an insignificant amount.
Oh, absolutely.
Tell me, so in your CPA, John,
Yeah.
Help me to understand in our hypothetical $5 million, to the viewers and listeners, that might seem like a lot. It might seem normal. It might seem like a little. $5 million, do we have, to create special trusts, from a taxable standpoint? I mean, we certainly don't want to give away half of the,
Right.
The death benefit or anything of the estate. How do we do that?
Probably not today. The $5 million customers is going to be covered by their unified lifetime credit. So they will not have an estate tax that would be due on a $5 million estate. But of course, things change. It used to be $1 million not too long ago. So certainly that would be something that we would have to take into account. Today, with, in essence, over $20 million that spouses can pass through between one another, not going to be as big of an issue for them in terms of is the life insurance taxable, but absolutely people of wealth. All the time we have, the folks that have these qualified insurance trusts to basically keep those funds out of the estate.
So let me just ask you to that point. What's the threshold number where you're looking at somebody saying, in this context, a regular trust, and if a regular could be revocable, irrevocable, but a living trust is fine. You, sir or madam, should have a qualified insurance trust. Is there a threshold number, or where do we?
Okay. It is absolutely clear that if you have a net worth of over 11.4 million, which is our federal estate tax exemption this year, that anything on top of that is going to be taxed at a 40% federal rate.
If it's distributed outside of a trust.
If the policy is not held in a life insurance trust during life. So that's assuming that I have my 11.4 million of my own assets, and then there's a policy on my life. Okay. That is, that I own the policy, and maybe I've just designated my former spouse as beneficiary. Right? Mm-hmm. That's taxable. Where it gets much murkier is for folks in states like Illinois, mm-hmm. where we have a $4 million estate tax exemption, not 11. Now, the good news is that it's a...
Let me put the pause button on that. So a state tax on 4 million, you said federal 11.4, meaning if I have 4 million, I'm not getting taxed at a federal rate, but I'm still getting hit at a state rate.
If I have 5, if I have over 4.
Over 4 million. Mm-hmm. Okay, I'm sorry to interrupt.
No, that's please. Okay. So, and then that's where people have to make a decision of, well, would I rather just buy a little more life insurance and not have to worry about creating a trust and observing the formalities of a life insurance trust on mm-hmm. an annual basis, knowing that there will be some state estate tax taken out at death.
Yeah.
Help me to understand this. I'm representing an individual. Say I've got a mother coming out of a long marriage. She's raised children, and she's going to get a significant amount of wealth in the divorce. But because she still has children, mm-hmm. perhaps the divorce decree requires the husband in this case to maintain life insurance at, again, $5 million. And so as the receiver of it, because in my divorce decree, I'm saying, husband, you have to maintain life insurance with a death benefit of $5 million base or death benefit. When that $5 million comes to the ex-spouse incident to this divorce decree, is there a taxable issue, or is there some way we can protect against that? In other words, does the recipient spouse get that $5 million free and clear, or are there tax issues on that?
Well, the great thing about being a lawyer is you can always answer with, it depends.
I've used that one before.
Okay, so if you're in a position in which there's a life insurance policy on dead life, mom is the designated beneficiary, mom gets that money free and clear, except that if any portion of that money is subject to federal estate tax and dad hasn't otherwise provided for the payment of that estate tax, either through his will or having sufficient other assets, then I am in a place where the IRS could have a tax lien, right? That's tax law. A transferee of property gets what's left after the taxes are paid.
Okay.
So how do you, as the divorce lawyer, protect for that? There are a couple different ways. You could certainly say that mom needs to get $5 million undiminished by estate taxes, and then let dad's side figure it out.
Mm-hmm.
Or you could require that it come in a life insurance trust that's not in dad's estate, and that the trust include provisions that would ensure that any taxes, if at all, say because it wasn't properly administered, come out of other assets.
Got it. Let me back up a little bit. I want to go back to kind of when I was saying chicken or egg, and you guys, how you work together. So someone comes to you, they've got $5 million worth of wealth. They've got, let's say, add to this scenario, they're getting $20,000 net per month and for maintenance.
Mhm.
Okay. How is it? I mean, I'm understanding there's a lot of creative tools we have available legally on the estate planning side of things to protect people's wealth, and even to sort of manage around tax implications and so forth. But how do you work within that construct in terms of the actual funding of that, and to make sure that the money's there? It's a great plan, but how do we make sure the money's there from an investment standpoint?
Well, it goes back to the financial plan to make sure that that 20,000 has a finite life to it.
Right.
We're assuming, and as part of that budgeting and kind of prospective look financially, what their life is going to look like 5, 10, 20, 30 years from now, is that sufficient? And so that's the most important piece initially, is to understand, with the maintenance, that's just their income, their expenses, the budget, the current situation. But beyond that, does that current savings that hopefully results from that interaction between current income and current expenses, does that provide for savings in addition to the assets that were received as part of the divorce, provide for the future retirement goals, other goals that they may have with respect to funding weddings and vacations and so forth down the road, as well as retirement.
Do you bake that in then? So for example, let's say someone comes to both of you and they say, listen, I've got this $5 million. My daughter's 25 years old. She's my youngest. I think she's going to get married in 3 years. So I want to make sure that's available. And by the way, I'm hoping we have grandchildren. And so I'd like to be able to set aside a certain amount of money for, my potential grandchildren, or if I have some at that point in time. Is that where you combined look to say, okay, number one, let's make sure we have the right provisions that provide for that. And then number two, a conversation is, how do we fund for that? Because I'm not going to take all $5 million and put it over here if I know 3 years from now we have a wedding, and perhaps 20 years from now we have college educations to pay for grandchildren. How does that work in terms of blending financial plan with the specific provisions in a trust or in a estate?
So, one thing that I think bears mentioning, because it's easy for most people to feel like 5 million sounds like a lot of money. But with our current estate tax exemptions, it isn't. And for people who are in that position of wanting to, fund a trust for a grandchild, to do, and clients do some amazing things, whether it's for grandchildren, for education, for charity. I mean, the things we see are really impressive. But all of those things cost money and require maintenance. And so you usually don't see too much of that at the 5 million level.
Okay.
We probably have a carve out and a will for grandchildren,
Yeah.
but it's rare that there's much done during life other than maybe a 529 plan or creation of like a custodial account for the grandchild. You want to elaborate there?
Yeah, absolutely. And we may have a situation. I love IRAs for people that beyond 70.5 years old. They may find that I don't need all the required minimum distributions to live on, and that becomes a fantastic asset to achieve their charitable goals of gifting, because it has the dual benefit of not only do the money that I give directly to the charity from my IRA not count as income, but also counts as part of my required minimum distribution. So I'm solving two things simultaneously. And then a great benefit as well is that when that's not treated as income, I have some folks in this situation where it gets them below the threshold over which they get lower Part B and Part D Medicare premiums. They like that. Whereas if they would have had the full amount of the RMD coming out, they would have been over a threshold, paid $10,000 more per year in the Medicare premiums.
I'm sorry, because let me sort of again bring that back down to my level.
Yeah.
So as part of a hypothetical, individual comes to you after divorce, part of what they received is a large IRA.
Right.
Let's say, for example, it's $2 million in an IRA. You said, I think 71 or whatever age they are, they're at a retirement age, correct or incorrect. Law says at a certain age, you have to start pulling out some of that IRA to you. True?
Absolutely.
Okay. So, and what I thought I heard you say in there is part of a plan you guys can put together is when that mandatory draw comes out, rather than it coming to me as additional taxable income to me now at 71, I can steer that through a plan so that it's a charitable contribution of some type, such that from IRA to charitable contribution, Uncle Sam doesn't tax me.
That's correct. And I was running off of Christine's situation where a person with $5 million, very rarely are we going to see, we're going to set up a trust that's going to fund that initiative. But this is one way in which they can feel good about the future.
Well,
doing it
and
way.
It's something you can do with up to $100,000 per year, which for someone with $5 million, 100,000 is
going to be more than
often enough for charitable. Yeah, it's
In
called
other
a qualified charitable.
$100,000 of IRA
Of
distributions
IRA
to me, I can shift into
straight to
charity, no tax.
Right. And we always say, coordinate that with the financial institution.
For folks with 5 million, where if we've done our jobs correctly and they're living up to a financial plan where they don't need all of that required minimum distribution, it's a great asset and a great way to achieve that objective.
Mm-hmm.
And is that something you guys look to do in terms of advising, clients coming out of divorce? You have, and again, we're just using this mythical $5 million. The goal, hopefully, is that, from the date of my divorce until the day I die, I'm not exhausting that $5 million. I'm trying to find ways to grow that on your end and then protect it from having Uncle Sam and others take it away.
Yeah, I mean, my job's gotten much easier for folks with $5 million because of those high estate tax exemptions. You still have to make sure that that $5 million is going to last for life.
And prudently build it over time.
Interesting. So with the tax thresholds, would you even advise an individual coming out of a divorce with 5 million in assets even do a trust, or is a simple will really
So
permissible at this?
in Illinois and in many states, we do a will and revocable trust in tandem, basically as a matter of course. Another word for a revocable trust is a will substitute. Why do we do this? Our wills are very short, and they basically just say, I name John as my executor and I give everything to my trust. The will is on file. It is public record. The trust, on the other hand, is a private document and remains a private document, unless, of course, somebody sues for some reason. But the trust remains a private document. And if the trust is funded during life, meaning if John and I have coordinated, and instead of John's investment account being titled in John's name, it's titled in the name of John's trust, that avoids the probate process at death as well.
Right.
So for anyone who has any level of financial complexity, we do a will and revocable trust.
Okay. And you touched on something which I want all the viewers and listeners to understand too, because you talk about probate. And probate is a system within the courts that really administers estates where either there is no will or if there's a will and there's a contest or something. So one of the things as an estate planner and as a financial wealth advisor that we all try to do is avoid people's heirs from ending up in probate court because of the costs and the delays and everything that goes with that. True?
Yeah, I mean, it's probate. A probate proceeding also occurs if there are just simply assets in excess of a certain threshold. So that's why we try to title them in the name of the revocable trust during life. Different state courts, sometimes you'll have in some states, you might have a probate court that addresses trust contests. In some states, it's a chancery court. So it's not necessarily the same court addressing an issue under a trust as an issue under a will.
I've had situations where we have a will, we have our powers for financial matters, healthcare matters. I'm set. I said, you are set except for one major piece. You own that vacation home in Wisconsin, as well as your home here in Illinois. Now you've opened up the probate process again because you don't have that trust. So it's another reason why we would basically have that client go back to Christine to avoid the probate process, to have all those assets, both the real property in Wisconsin in this case, as well as Illinois, titled within that person's trust.
So in other words, if you have this great estate plan put in place legally, you're crushing it with people's investments. But outside of that, they have this secondary vacation home that they simply put into joint tenancy, for example.
Yeah.
The trust doesn't control that asset upon.
Well, the trust will control that asset, but we have to get it to the trust.
Yeah. It has to exist.
We have to
a lot
get
of times
it
they
to
just had a
the
will.
trust. And so let's take the two scenarios. One, they just had a will, and two, they had a will and revocable trust, but they didn't take the time to title the vacation home in the name of the revocable trust. If they just had a will, chances are that we're opening probate here in Illinois, and then we have to open what's called an ancillary probate, yet another proceeding in Wisconsin, because it's real estate and it's governed by the laws of Wisconsin. It's local, and that doesn't apply just to Wisconsin. That's pretty much universal. If it's a question of they had that will, they had that revocable trust, they had that great plan, and they just never took that final step to move the vacation house into the revocable trust, and that vacation house is still a probate asset. And remember, our wills are short, but what our wills say is, I take my estate and give it to my trust. Assets don't go directly to the trust, they go through the will to get to the trust. And that's what probate does.
Interesting. So I think fascinating conversation. We could go on for hours and hours. I think what I was hoping really to be able to provide the viewers and the listeners is really just sort of a frame of reference most people in a divorce don't even think about. There's so many people, even that are married couples, that really haven't thought through estate plans, haven't thought through financial plans, haven't sat down with you. And so I think what happens in my world as a divorce lawyer is individuals are forced to really think about these things, especially when somebody comes into a financial situation that they're not accustomed to. And so it's really, really valuable to me as a divorce lawyer to have resources in the financial world and in the estate planning world. And I think the takeaway from this is we can protect you, we can manage your estate, we can put up plans, but there's a lot to it. And it starts with kind of understanding where do you want to be? And then how do we back end and we make sure we dot I's and cross T's and put the Wisconsin property into it and change the beneficiary designations and really make sure that everything is covered. And really this is for the benefit of those individuals to some extent on the financial side while they're living the remainder of their life, but then also for their heirs and to try to be financially responsible, but also try to take the as much as you can eliminate some of the legal problems one might have, in saying, this kid gets this kid gets that. I want it, here's what it is, and it's controlled legally. So I think it's really, really helpful. Again, Christine, just again, for the viewers and listeners, I know I mentioned Schiff Harden, the firm in which you're a partner, but if someone wanted to contact you and get more information about estate planning, regardless of whether they're coming out of a divorce, how would they get in touch with you?
So all of our contact information is on our website, Schiff Harden, SCHIFFHARDIN.com. And you can find me by email. You can find me by phone.
Awesome. Christine Quigley, Schiff Harden. John, same thing. How do people, if they've got investment issues, either coming out of a divorce, in a divorce, or maybe just generally speaking, how do they get in touch with you?
They can contact me again through our website at www.trustbenchmark.com. My email is just jswift@trustbenchmark.com, or contact me into my office, 312-259-9595.
Awesome. And again, as always, if you have questions of me, I can be reached at www.beermannlaw.com. James Quigley, your host. Again, thank you very much for joining. I hope this has been informative to all of you. Take care.